Imagine waking up one morning, checking your portfolio, and realizing that the stocks you trusted for years are suddenly down 30, 40, even 50%. No warning, no second chance. Just panic across the market. Now imagine knowing ahead of time which stocks are most vulnerable before a crash happens. That's exactly what today's video is about. Warren Buffett, the most successful investor of all time, has been quietly giving warnings for years. Not by shouting, but through his actions, his interviews, and the stocks he avoids. Most investors miss these signals. In this video, I'm going to break down what Buffett's behavior tells us about which stocks could be the most dangerous to hold before the next market downturn, and why ignoring these warnings could cost you years of savings. Before we go deeper, if you care about protecting your money, building long-term wealth, and avoiding costly investing mistakes, make sure you like this video and subscribe to Wealth Playbook. This channel is all about smart, defensive investing strategies used by the world's best investors. And subscribing now helps you stay one step ahead of the market. It also tells YouTube to show you more content that actually protects your wealth instead of hype. Now, let's talk about Warren Buffett's real warning. Buffett has always said that market crashes don't surprise him. What surprises him is how many people are unprepared. He believes crashes are not random events. They are the result of excessive optimism, easy money, and investors chasing returns without understanding risk. When markets rise for years, people forget that prices matter. Buffett never forgets this. One of his most famous rules is simple. The price you pay determines the return you get. When stocks become overpriced, even great companies can become terrible investments. One of the biggest danger zones Buffett has warned about indirectly is highly speculative growth stocks with no real earnings. These are companies whose stock prices are built on future promises instead of present cash flow. During bull markets, these stocks feel unstoppable. Investors justify insane valuations by saying things like "this time is different" or "growth will fix everything." Buffett has always stayed far away from this mindset. He doesn't invest in companies that rely on cheap money, hype, or continuous capital raising to survive. When interest rates rise or liquidity dries up, these stocks are usually the first to collapse. Another major red flag Buffett has pointed to is companies with excessive debt. Debt looks harmless when interest rates are low and profits are rising, but when a downturn hits, debt turns from a tool into a weapon against shareholders. Buffett prefers companies that can survive without borrowing. He has repeatedly said that leverage magnifies mistakes. In past crashes, many companies didn't fail because their business was bad, but because their balance sheets were weak. Highly leveraged companies often collapse, not slowly, but suddenly. Buffett has also quietly reduced exposure to sectors that rely heavily on economic booms. Cyclical industries like luxury goods, speculative real estate plays, and overbuilt industries tend to suffer the most during recessions. When consumer confidence drops, people cut spending fast. Buffett understands that durability matters more than excitement. He prefers businesses that people use regardless of economic conditions, such as insurance, consumer staples, and essential services. One of the most overlooked warnings from Buffett comes from what he does with cash. When Buffett holds large amounts of cash, many people criticize him for missing out on gains. But Buffett doesn't see cash as wasted money. He sees it as optionality. Cash gives him freedom during crashes. When markets panic, he doesn't panic. He shops. Historically, Buffett increases cash holdings when valuations are stretched and deploys it aggressively when fear takes over. This behavior alone should make investors question whether now is a time to be aggressive or cautious. Another dangerous area Buffett avoids is businesses he cannot understand clearly. Complexity hides risk. Financial engineering, exotic derivatives, and opaque business models often collapse under stress. Buffett has said many times that if you need a spreadsheet to justify an investment, it's probably not a good one. During market downturns, transparency matters. Investors flee uncertainty. Stocks with unclear earnings, confusing accounting, or unstable business models tend to fall much harder. Buffett's warning is also psychological. He has said that the biggest risk in investing is not volatility, but behavior. When markets are rising, investors feel smart. When markets fall, emotions take control. Stocks that rely on constant investor confidence rather than business fundamentals are especially vulnerable. Meme stocks, hype-driven trends, and story-based investing collapse fast when sentiment changes, Buffett doesn't chase popularity. He waits for value. Let's also talk about valuation risk. Buffett has openly said that future returns from the stock market depend heavily on starting valuations. When price-to-earnings ratios are stretched across the market, future returns shrink. This doesn't mean a crash happens immediately, but it does mean the margin of safety disappears. When something unexpected happens, whether it's economic, geopolitical, or financial, overpriced markets have no cushion. That's when crashes accelerate. Another sector Buffett has been cautious about is companies dependent on constant consumer borrowing. Credit-fueled consumption works until it doesn't. When consumers become overextended, spending slows rapidly. Businesses that rely on financing, buy-now-pay-later models, or discretionary credit usage often face sharp revenue declines during downturns. Buffett prefers businesses that don't depend on people borrowing money to function. Buffett has also warned against blindly following trends. He famously avoided tech stocks for years, not because technology was bad, but because valuations and business models were unclear at the time. When he eventually invested, he chose companies with strong cash flow, brand loyalty, and pricing power. The lesson here isn't about avoiding technology, but avoiding investments you don't fully understand simply because everyone else is making money. At Wealth Playbook, we focus on learning from actions, not headlines. Buffett doesn't ring a bell when markets are about to fall. He signals through patience, selectivity, and discipline. When he slows down buying, raises cash, and avoids speculative sectors, that's not fear, that's preparation. One of Buffett's most powerful warnings is that risk comes from not knowing what you're doing. Many investors think diversification alone protects them. But diversification into overpriced, low-quality assets doesn't reduce risk, it spreads it. Buffett believes concentrated investments in high-quality businesses, bought at reasonable prices, are safer than owning dozens of overpriced stocks. As markets mature, returns shrink and risks grow. Buffett has repeatedly said that the best time to prepare for a crash is before people believe one is possible. The worst time is when fear is already everywhere. Right now, many investors are still chasing upside without considering downside. That's exactly when caution matters most. The key takeaway is not to predict crashes, but to survive them. Buffett doesn't try to time the market perfectly. He builds portfolios that can endure stress. He avoids businesses that require perfect conditions to succeed. He stays away from excessive leverage, speculation, and hype. These principles matter more today than ever. As we move forward, remember that markets reward patience, not excitement. Crashes don't destroy wealth permanently unless you're forced to sell. The investors who suffer most are those holding fragile assets that collapse when conditions change. Buffett's warning is simple but powerful. Own businesses, not stories. If you've made it this far, you're already thinking differently than most investors. Let me know in the comments what sector you think's most at risk before the next crash. I read every comment, and your insights help shape future videos on Wealth Playbook. If you found this valuable, share this video with someone who needs to hear this before it's too late. The right information at the right time can protect years of hard work. Stay patient, stay disciplined, and remember, the goal isn't to beat the market in good times, it's to survive the bad ones. I'll see you in the next video.